Today, folks, we got to dive into two Canadian stocks that are absolutely popping off right now thanks to earnings. Manulife, for you dividend lovers, this thing is up damn near 8+% today alone and has broken a trend that it hasn't done in over a decade. Got to discuss this, including the future of their dividend growth and share buybacks, but we should also talk about Shopify, a stock that absolutely cataclysmically crashed on earnings and now is rallying back. And if you appreciate the rallying back, good for you that if you bought the dip. But if you guys are on your path to financial independence to perhaps one day retire early and you want to join me on that journey, go down there, consider subscribing and hit that like button for the Canadian earnings stories that I will be covering on this channel this week, because this day alone, like many US stocks that have been rallying aggressively, Canadian stocks are now coming back into play. I'm shocked taking a look at energy stocks rebounding dramatically. CNQ doesn't even have earnings. It's up 4% today just because so many big institutions started to buy back the stock. It's down, it's slightly suppressed. Manulife up 8.74%. Shopify rebounding 3.14% today. And the whole broader market is up anywhere from 1% to 4%. It's just crazy. But let's talk about Manulife, because this is what's truly astonishing. If you bought the 2022 lows, you've seen a 50% return. This is a stock that is more or less flatlined since basically 2017, has not done anything until as of recent is now breaking that trend line. Now, I don't think people appreciate Manulife enough. I know I don't, and it has some metrics behind it that are going to blow your mind. Starting yield today, first and foremost, 4.38%. The dividend growth 10 years ago, 13 cents to 37 cents today, but the past does not constitute the future growth. We're going to talk about that because many of these dividend behemoths in Canada are slowing down on their future Geiger growth for their dividends. But I want to point out, this is one of the 10 largest life insurance companies in the world. And I've never really kind of grasped this, considering this company's been around for over 100 years and they are diversified equally against Asia, Canada, the US. And it's really important to kind of understand this global diversification, because your money isn't all in one basket. It's very, very well diversified, offering a little bit more stability to the business. But I don't know the income attributed to certain costs with insurance, because their EPS growth was 17% for 2023, which is incredible, right? But what was most incredible was the net income, basically for Q4 at $1.65 billion, up 81% year over year, being a huge contributing factor to the total income for 2023. So it's very fascinating what they're doing here as a life insurance company. And again, you just read through some of these stats. Again, they're just staggering, right? Like $1.4 trillion in assets under management, net, basically segregated funds of net assets of $417 billion, which is invested assets. I just can't get over it, right? Like, this company is just, insane. So let's talk about the guidance and expectations here for common stock buybacks and dividends, because it's been slowing down. I mean, they went from 1.9 billion in 2022 to 1.6 to expected to be 1.2 in 2024 for share buybacks. Dividend payouts from 2.5 billion to 2.7 billion to 2.9 billion. They're just incrementally raising it by about 200 million a year, which at scale is, the Geiger is slowing down, right? So you're not getting the same growth. So this is probably one of those better stocks, like many of the Canadian conglomerates, that is better to be picked up on dips, like Enbridge right now, because all these companies are slowing down their dividend growth, but are offering much higher yields than they statistically have in the past. Current payout ratio, great spot, 56%. Most of the Canadian behemoths have really great payout ratios, really current high starting yields. You can get anywhere from 4 to 8% on some of the biggest companies in Canada today. So that's Manulife. Fascinating story. I'd love to know what you think. Are you buying it as a part of your portfolio? The current market cap at $60 billion puts it, I think, in the top 20 to 30 largest companies, where Shopify right now is on path to potentially being one of the largest companies in Canada again. At $144 billion, I think it puts it now in second or third place, because Royal Bank, I think, sits at $180 billion next to TD, what's TD's market cap right now? Should we just take a quick look? TD is trading at about $145 billion. So yeah, it's about to surpass TD, becoming the second largest company in Canada, and it was probably before the drop on earnings. So it did drop pretty dramatically and is now recovering. It's almost up 8% since the earnings low, and a lot of people are pumping this stock pretty heavily right now, and I'm going to try and be mostly biased because I lean more toward the edge of caution. I don't really trust Shopify because, unfortunately, there's so few Canadian tech companies. They have become more or less extremely bubbly, and we'll talk about that. That doesn't mean the stock can't grow and doesn't have a really bright future, but Shopify's shares are down because they reported light guidance. They're kind of lowering their expected margins and a few other details, because Wall Street was projecting about 13.6, I believe, on their cash flow margins, but I think Shopify said they're going to be doing single digits. Not sure why, considering The numbers do look pretty good. Revenue growth went from 5.6 billion to 7 billion between subscriptions and merchant solutions, and most of their growth is becoming from merchant solutions, which I'm not sure what they're offering merchants, whether it's, I know they've been getting into lending capital. They were trying warehousing, which they ended up selling, I believe, those assets to continue to offer better margin and an earnings per share. And that's what kind of worries me about this company, because you look at their sales and marketing, they've cut slightly, which is nice to see, but they're paying Mr. Beast probably a huge percentage of this capital. I mean, Mr. Beast is probably costing them an arm and a leg, considering I've seen those marketing materials come up in his videos. Research and development continues to grow, so total operating expenses is eating into a good chunk of that gross. But I mean, you know, they did pretty good. Other income, about 1.6 billion net is not that bad, but still lower than the year prior, right? For 2022, that doesn't really matter because they're a growth-based company, and their growth rates are now sitting at about 25 to 30%. Seems to be playing in this range, which is great at the scale of a company of this. But again, I have a lot of concerns because you take a look at that gross profit, they're not actualizing a huge percentage of it. And that means their earnings per share PE multiples in the 100 plus. I mean, to pay 100 times multiple for a company like this, it kills me inside a little bit. You know, I know they can actualize a lot more of that revenue, but even at the gross profit of, what did I say, they're $3 billion is what they have, their total gross profit here is 3.5 billion. So even that is almost 50 times, you know, their current market cap, which is just absolutely insane. So like, I have a really hard time stomaching the valuation of these Canadian tech companies and comparable. I mean, honestly, if Tesla keeps growing revenue at 20%, it would make Tesla look cheap at Tesla's current valuation, right? So you have to kind of understand that these aren't cheap companies and they have to meet insane expectations. And it's also fun just looking at the breakdown of, you know, what kind of products, merchants are selling on Shopify. And it really shows you this is a small kind of business oriented, it's small town America. I mean, most of their entire stores are based around apparel, home and garden, beauty and fitness, food and drink. So these are people that you would see, like Kanye West selling his t-shirts, and people selling drinks, or Mr. Beast selling his chocolate bars. Like, that kind of, I think, represents more small town America than it does big business. So it's interesting to see the different products that make up the vast majority of their sales category. So something to just dig into, because you really kind of get a grasp for who they're servicing in their client basis. And I think this is going to continue to grow nicely. I think e-commerce, online shopping, and running your business online is the future and will likely continue to dominate. And obviously they're collecting a ton of data that's going to have some value. But Shopify, remaining buys, do you think it's a buy here? Do you think it's overvalued? I really think it was a bubble that burst. It dropped 47%. They did a ton of layoffs. They're cutting costs, and they're starting to try and get a rebound on earnings. But I don't know if it's justifiable at 144 billion. Manulife trading at a 12 times multiple, great dividend yield, probably a bit more of a reliable stock in the short term. But again, long term, Shopify could become a behemoth. But that's up to speculation, and I'll pass that question off to you. I'd love to know what you think in that comment section below.